All right. I have a pretty interesting live conversation here for everyone. This is... Let me hit that mute button 1 second. Sorry, guys. So this is the first in the series of Crypto Talks. This is a live series podcast interviews brought to you by Genius X and Learn Cardano. We're here to talk about various crypto related topics. We'll be bringing in a lot of crypto experts from around the world. We're covering everything from crypto startups, regulations, tech breakdowns, and much, much more. You can follow the Genius X crew at official Genius X on Twitter. And you can also find out more information on their website at genius-x.co. It's .co. Make sure you type in the .co bit. And of course, you can find everything else about us at learncardano.io. You can follow us on Twitter and also on my Twitter account at AstroBoySoup. So I'm your host, Peter Buey, and we're joined with some very special guests from Block Investment Group. I have David Hooverman, analyst and trade strategist at BlocTech, and John Paskowitz, I hope I said that right, investment and advisory analyst at BlocTech. And we also have Dikemba Bagalu, head of finance at Genius X and Genius Yield as well. So gentlemen, welcome to the podcast.
Glad to be here. Thanks for having us.
Okay, now
happy to be here.
Always love to do just a quick audio check with my guest to make sure that's working there. Yep, okay, I think we're good. So we're here to talk all about how VC funds and how VCs invest in general, but in particular in a bear market as well. So first off, let's start off with a little introduction, and I would love to learn a little bit more about yourselves there, John and David. So David, how about we start with yourself and then move over to the John, and then we'll do a little introduction for Dikemba as well.
Perfect. Yeah, I was fortunate, got started in the crypto space relatively early. Actually kind of transitioned from the gambling side when online poker and sports betting was really a harsh ban came through, and found out about this Bitcoin thing, and then transitioned to start moving more of my interest to the crypto market in general, as seeing what it was doing. And got my first position with a private equity VC firm in late 2017, and have kind of continued in that realm for some time, as well as doing some consultation, and now working with Genius X, helping out there as well, and trying to bring some education and knowledge, and really trying to help some of these earlier projects get some good grounding and some good feet beneath them, and really get launching. So I'm happy to be here. Thanks for having me. And yeah, let's hear it from John. I've never heard anyone get his last name correct the first time, so you're pretty close. Well done.
Yeah, it's got some of those Polish consonants, right? Throw you for a loop. Paskiewicz. Not as bad as it seems. I'm really blessed in general, but really glad to be here with you, Pete. I started really in the crypto space as a retail speculator around the same time as David. We when we met, we immediately clicked on some of the same events and same people, and got into trading, automation, and algorithm construction. Was able to develop some success there. Wound up working with the VC here now, and today I'm running with the Genius X crew, working on incubating new projects and really trying to put some value into the space and be helpful to move us forward.
Brilliant. And Dikemba, what about yourself? You might as well introduce yourself. You have been on the podcast before.
Yeah, definitely. Yeah, thanks for having me again. So my name is Dikemba. I'm the head of finance at Genius X and Genius Yield. I got my start in blockchain or crypto some years back, but really just started from the retail side of being interested in the technology. Of course, like everybody, I bought Bitcoin, but then I learned more and I moved to Ethereum, and then I started moving to a lot of other blockchains. I've also now, at least for Genius Yield and Genius X, I help, at least for our Genius X companies, them with financial forecasting and modeling, as well as tokenomics design. So helping them build a token economy that goes along with their products and hopefully create utility for them.
Absolutely brilliant. Thank you for those introduction, guys. Now we've got a whole bunch of questions. I've got a whole bunch of questions from myself, which I've put together for the team here to ask about VC funding in a bear market. But we also managed to collate a lot of questions from the community as well. The live chat is there, so if you're coming in now and you've got a question for the BlocTech team here, please leave a comment within the comment there on the YouTube stream, and you'll be able to ask the team directly as well. But first off, let's go with the first question here. What does an investment firm such as BlocTech look for when potentially funding a project? So I don't know who wants to take this first question.
I'll jump in. An investment firm like like one in the space. We'll keep it crypto kind of centered. We're going to look for the size of the market, the product, the fit, the need for that particular service. We're going to look at it on the nose in a very pragmatic way, right, Dave? Does this thing need to exist? You know, is this a vehicle that can put a return to the LP's money? You know, that's the question. There's a lot of great ideas and really interesting things that we encounter that don't have a need to be monetized yet. You know, don't have a need to exist as a full-fledged startup. So we filter it, I guess, yeah, in that pragmatic sense first. We also want to look, you hear probably this theme echoed throughout this conversation, especially as we get into talking about maybe more difficult financing or funding climates. We look for a path to revenue. You know, are we going to stay in the idea phase? Are we going to be able to get a return? Are we looking at a series of successive raises? We want to uncover a solid business plan. We want to look into founders to a principal team that isn't necessarily the most experienced in the space. Sometimes there's a divide between, you know, PhD projects, right, and folks coming in who are not nearly as credentialed. And that's nice that it's so, I don't know, democratized. It's so fair to all to enter the space. But yet you want to meet the team, right? Like you got to know who you're betting there. Lately, we would be looking at compliance. You know, if we run into projects with plans that are going to be compliance nightmares from the go, it's a red flag. And if we run into a startup that's maybe resistant to us doing some diligence or some analysis, that can be problematic as well. So we look for transparency there, you know, and we look for some willingness to cooperate. David, I don't know, you could probably dovetail a little bit more on that. Each investment firm has its own criteria, and it can vary from firm to firm. But in general, I think these are pretty common principles across the space, you know.
Yeah, there have been countless times where we sit down with early stage companies and they come to us and they are selling us a problem. And they're trying to sell this problem super hard, and then they kind of flip midway through their pitch or the last three quarters or the last quarter of their pitch and say, but this is what we're going to do, and here's a solution, and this is what you want to invest in. And when we look at this, we think, okay, if we're going to invest, or if we're going to recommend investment into your company, why are you selling me a problem that you have to sell me so hard? Realistically speaking, if you have a solution, the problem should be relatively evident. If you're saving me time, if you're making me money, or if you're saving me time and money, if you're providing that solution to help facilitate something more efficiently than what's being done now, it's kind of a no-brainer. So selling that, if we start seeing someone, you know, start off by selling a solution first, and the problem self-evident, that's generally, you know, a really good sign. But to John's point, it's, you know, the compliance nightmares with what we see with FTX here in the States, cracking in the SEC.
Martina.
Ripple's been in a fight with the SEC for going on 2 years now. I'd hate to be able to foot that legal bill. sure there's quite a few people making millions off of that. So compliance is definitely a huge aspect. And further to John's point, the addressable market. You know, who is this a niche product for a small select few people? Are they going to spend a lot of money on it? Can they spend a lot of money on it? Or is this something for the broader retail market where tens of thousands, hundreds of thousands, people really want this solution, just no one's done it yet, or you're doing it better than the other solutions that are currently available?
Now, John, you mentioned something a little bit interesting a little bit earlier there, and that was the transparency of the project itself, and when you're digging into the project and whatnot. Now, there was a question from the community, and this was from Twitter user Ready Player Mr. B, and I think this relates to like some various projects that are anonymous, like Pavia, Metaverse. So do you guys ever invest in companies with anonymous teams or anonymous developers even in there?
Well, an anonymous project can be problematic. It never is a funny thing to say, and I know some colleagues, David, what I'm thinking of, who have solicited some support for some anonymous projects. But in general, it's gonna be a burr in the saddle for the diligence process. And if you're looking at really towards gearing the business out to a Series A type raise, for example, or some larger goal, it might hinder you. Look, there's lots of money that's squirreled away places. Old crypto, well, relative crypto being a new space, right? Relatively old crypto money, but when we see movement from old wallets, Satoshi era wallets, these headlines that get our attention, we know that there's still money sitting there, and so there's a lot of folks who just out of belief may do it. But I think when you try to formalize the process, then you may run into some rubs.
Okay, so yeah, go on, John. Go on, David.
I was just going to say there are people who will, and usually individuals investing in anonymous projects is more common, but VCs or private equity firms, if the team is not willing to come forward, I guess the other side of that is, well, what are we going to be investing in? Are we getting tokens early for something? Are we going to get equity in something that isn't actually formed? So there's a way to do it where the team can be anonymous from a public facing standpoint. However, in private conversations, they can come forward and dox themselves, and there's ways to do that. Here in the States, using a Wyoming LLC or Delaware LLC, members of that entity can still remain anonymous from a public-facing standpoint, but still be able to approach VCs and dox themselves. Developers are kind of here and there. It really depends on what the project is.
Okay, brilliant. Now, my next question is around how do you guys even find these projects? There must be so many of them. Maybe the projects find you. I know Genius X does a great job of finding a lot of projects and bringing them into the space. So how does BlocTech go about finding new projects?
Well, probably two primary ways. The first is through referral, is through relationships network. Those usually yield better results, right? Because your friends don't want to waste your time, well, at least good friends won't want to waste your time on projects that just aren't viable or aren't a fit for what your investment strategy is or what your portfolio, your ecosystem needs are at that point. So definitely through our connections and our networking in the space, we have lots of projects and good projects referred our way. And even if there's not an investment fit, sometimes that relationship fit sometimes echoes out into some type of shared benefit later. The second way is there's lots of investor databases. And I'll just tell you, once you get into Crunchbase as a source of funding or another database, you'll have a full inbox every night for sure, because there's no drought for projects needing money.
Yeah, I hop in and ask a question, because I know a lot Cardano-based startups will want to know, how do they stand out versus the thousands of emails you're getting? How can they go about getting venture capitalist attention?
Sure, this is just raw. This is just raw personal opinion. You know, don't be asleep at the wheel. Get your product messaging correct. Okay, have a good presentation. Have some of the things I mentioned earlier. Have a clear path to revenue. If I'm going to the bank and asking for a loan, I don't have to put on a nice shirt anymore, right? But I'm the kind of guy who still will, because I'm going and asking for money. And so that, translating that thinking out a few more steps into this environment, if you come correct, you're going to stand out, right? It doesn't guarantee you funding, okay? But it does get you attention. It makes you different. Sometimes the product is so muddied in a pitch, and it's so unclear. The problem, like David was mentioning, the problem is dropped on your head so heavy that there's no clarity in what the heck this actual product is. And that'll get you sunk pretty quick as well. So your pitch is real important. Your product messaging is really important, and working at it to develop a relationship with someone. When I receive, an email several weeks after I've already met with somebody saying, "Hey, I'd like to meet you for funding," I know that projects are very busy. Okay, but if that was to happen again, or another ball was going to be dropped, it might be a sign that, hey, they're not in this fundraising capacity 100%, or maybe they need some help. I'm trying to dance carefully with my words and not damage anybody's feeling at a startup who's doing their own fundraising. But if you're asleep at the wheel, there's so many empty hands just knocking at the door that you'll get. I think you get passed over pretty quick. You got to be on top of it. Follow-up matters, presentation matters, and look at it in terms of, I'm going to select VCs and partners who are good for me. I'm not just, I know you have to shotgun and you have to find funding where you can get it. But if you look at it in terms of, I'm going to find a fit with them and pursue it like a relationship, you go farther. David can attest to, there's been numbers of projects who we weren't able to meet with, or were not first appealing, and they were persistent. It bore fruit, Dave, I don't know if you can shade any more detail on that.
Yeah, I mean, individual ecosystem fit for whichever firm or group that you're going after is kind of a big deal. So if you're reaching out to a firm that only does Series A financing, or only does seed financing, and you're pre-seed or pre-revenue or angel round, really understand who you're targeting and ensuring there's that fit of, you fit the qualifications that they generally look for. And then, depending on what that stage where you're at, come with everything that you have. Be fully prepared. Have a data room. Have your product, if it's at MVP or whatever, try to have something tangible that you can show an investor, hey, I can not only just type up great documentation, but we actually built something, we did something. And if you're making revenue and it's $50, if it's $1, that first dollar is the hardest. If you can say, yeah, we're not profitable, but we're generating capital, that definitely brings that perks interest. It shows that there is somebody who's paying for your product. We're going to dig in a little bit more. Some of those things are how you can stand out as far as what's next, or how to get in front of these people.
But sometimes we get large amounts of projects thrown all at once that are really just trying to take advantage of overcapitalization in a space, right? Because some folks may have an investment mandate. Oh, good, let's get into the metaverse. Let's get into play to earn gaming. Right? And they follow these mandates somewhat blindly into an overcapitalized sector where bad projects get funding. It can happen, but we can see that. So when the sector is no longer red hot, you see who's left. Those idea projects fade away. When we see projects, Dikemba, you could stand out from projects that just appear, and this is going to change a little bit with the landscape as well, with some of the token activity kind of being altered to take a more conservative direction, to be more compliant. But we see projects, a lot of projects that either look like a front-end token exit and not a business, right? When I'm looking at a roadmap and I'm like, hold on, your exit plan is like before anybody else tastes anything, before a product hits the market, and you're counting on tokens, or you're counting on I refer back to overcapitalization. You're counting on money just coming in kind of dumbly. That's a problem. That's a problem. If I see a product, well, it is, man. If I see a product that's going to stand alone, if I see a product that's going to stand alone in any market because there's a need and it's a good darn product, cool. Get that messaging right so that the bigger types can hear it.
If you're going to have a token in this market, though it's still a new and emerging market, you need to ensure that your tokenomics, that there's actually a real use case for your token. And that's, a lot of companies try to raise on tokens that really don't have a real use case. So especially for those projects who have token only raises, ensure that your token has a strong value to the product or to the game or to the ecosystem in which you're building in. That'll give it real value. I mean, it's great to raise money off tokens if you're never going to use them and you don't have to give up any equity or any ownership of the company. But there are quite a few people realizing, not only on the institutional side, but also the retail side, your bulk buy groups or your pre-seed, early round pre-sale groups that come around, they're getting relatively smart now. Some of these guys have been around since 2015, 2016. They've seen these cycles a couple times where if you're going to come to the market with the token only raise, you better make sure that token is intimately involved with every aspect of your solution that you're bringing forward.
Well, there's inherent problems with that token model, okay? To find enough liquidity to realize any kind of profits is a problem. When we did some research, it was, I don't know, within the last 12 months, we realized that a statistically significant number of projects returned to the seed price or below shortly after, right? Yeah, right. Shortly after these events. That's a problem. It's in a good market, it's an opportunity for somebody, but it's a problem. And the tradition of just team distribution happening, as a matter of that's how it's accepted in the space. We're not seeing so much of that, which I think is encouraging. It's not like I said, like a friend and money party. Hey, we've got our token launch and it's frog walk, guys. We're seeing that go, and it has to go away, Pete, because a lot of people I talk about there may be problems with liquidity or there may be problems with price. There's always this intense sell pressure on these coin deals, these seed coin deals. There's always just this incipient sell pressure that's coming. That's a problem for small people who participate later. So it needs to mature a bit, and it will.
Okay, well, we'll go into a little bit more about how VCs use their tokens and whatnot, but there's so much more I want to ask as well. Now, this particular question comes from the community as well. This one came off Twitter, and this was from NFT Rescue. Now, in terms of NGOs that are building in the crypto space, they're not usually open to VC funding. What type of other alternatives or opportunities would they have in the space?
Unfortunately, NGOs are generally big tax write-offs for high net worth individuals or companies that have an aligned message, I guess would be a good way of putting it, where what's good for the community is good for the company. So they're going to partner with NGOs to do good for the environment, good for sea turtles, good for whatever, find a underserved population and try to solve some real issues, which is great, but there are political and other issues at hand there. So, I mean, realistically speaking, you're just going to have to find those companies, find those people that have um, those same thought processes, those same, emotional responses to, what you're trying to help out with at scale. That's really what I've seen. And I've tried to work with and come up with creative ways with some legal teams in this area. And it's a nightmare. And most of these NGOs don't have a couple $1 million to spend on multiple legal teams to find out all the ways they can circumvent some regulation and work within the laws to become a credible company or credible NGO. But it's extremely difficult, to say the least.
Right. This question I have here, this comes directly from a community member in the Brisbane Cardano meetup space, and they're with a startup at the moment where they're trying to launch a token, and they're trying to raise the money to go through the legal processes of it. And they can't get past that initial stage of just getting their legals in order so that they can ensure that they're issuing a token properly to move on to the next stage. How does a project like that get some funding just to get past the next few steps in the process?
Find a lawyer who's crypto friendly, who you're willing to bring on and essentially sell them on the goal, on what you're trying to build and what you're trying to do, and actually bring them on, give them part of the company, give them some of the token distribution as well. That would be the lowest hanging fruit, but the easiest barrier of entry as far as this goes, because once you do it in Brisbane or wherever you're at, if you find a local, lawyer who's crypto friendly and crypto centric, that they probably already know this and they can do it relatively, off the back of their head. Still have to pay for your company registration and everything, but you won't get hit for legal fees and the documentation fees as they'd be providing that for you.
Cool. That's good advice. It's for a lot of projects, the legal aspects are like the biggest hurdle to get past and get started, and then they can do everything else around it, raise a little bit of capital through an ICO or whatever it is, but it's just that initial stage. So thank you for that particular tip there. Now, we were also just talking about tokens there as well. So in terms of how VCs get into various projects, is it mainly through tokens? Like, is that what you guys normally get from projects?
Sometimes we'd get only tokens, but generally it's a split between equity and tokens from the projects that we've seen, the deal flow that we've gone through. Very rarely is it token only, and that's really been because some of these lockup periods, some of these distribution cycles, 4 and 5 years long. From a VC firm to say, okay, as a general partner, I'm gonna say, all right, I'm gonna invest this money, and then I have to tell my LPs that, hey, we have these tokens. We can't really do anything with this capital, and it's slowly unlocking over the next 5 years. It's kind of a hard sell at that point, whether, when it comes to equity or you can use equity in a different type of fashion, and you can get rid of equity. You can sell equity depending on how that deal flow goes. So token only deals are difficult, but they're not completely off the table. It really just depends on the project and how early they are in the development of their overall business model.
Now, while we're talking about it, I just want to jump over to Dikemba there. How does Genius X usually take on projects? Do they take on token and equity, or just tokens? What's the general go with Genius X?
Yeah, well, all the final terms are negotiated company to company, but we typically get a small portion of the equity and we get a small portion of the tokens. And so, the way we're compensated is that we're taking a long-term view, obviously, of the company instead of taking this big upfront payment that if the company does well, then we'll do well. But yes, it's typically a small portion of the token supply and the equity.
Brilliant. Thank you for that. Now, in terms of all this money that's flowing through, where does it all come from? I'm assuming you've teamed up with various investors in your own company, and that's where some of the money is coming from. But for some of these projects, it's a lot of money that flows through. Like, where on earth does it all come from?
Comes from LPs, limited partners, who are have either made money through institutional means or high net worth individuals. Sometimes, well, there's not a whole lot more complexity to that to it than that. Whose money is aggregated. You know, some venture capital firms do have maybe a trading arm or another source of revenue where they're providing incubation or advisory or compliance services. Maybe first to those in their portfolio and then to others for to generate some revenue, right, for some monthly revenue there. But I think by and large, the money comes from the LPs.
Gotcha. Okay. Now, in terms of VCs in the Cardano space, like there are a lot of venture capital firms that do invest in Cardano-related projects, but for a lot of the sentiment, it feels like an anti-VC chain. It's like, you know, you can go over to Solana and play with them if you love the VC kind of thing. But, you know, we're community driven, community grown over here in the Cardano space. So how does crypto enthusiasts see BlocTech? Like how's your vision and perspective in the crypto space in general?
Just a quick question: Is Solana actually back up and running, or is it down again? I keep getting confused. If it's up or down. It's weird.
It's still in beta, so you know it doesn't matter.
Okay, that's fair.
I don't know that there's necessarily any kind of bias against Cardano overtly. That like, oh no, man, we're only if I have time for it, or don't let that riffraff in the door. I do know that I do hear it. Maybe it's a little slow, and so when you're looking for a clear path to return on investment, and something maybe poses a longer development process, maybe it's a better process, sure, but a longer process that might be daunting. But personally, no, I have no problem. A good project's a good project, right? And that's what's up. As far as VC perception in the space, it's a funny thing. So you've got people who need money, and if you don't give it to them, their opinion of it is probably not going to be immediately high. I'll just throw that out there.
Fair enough.
Right?
Fair enough.
But also there's some resistance to the diligence process that I sense sometimes when I'm talking to founders, and I don't want to pin that on the old lingering maximalist attitude or anything like that. But there is kind of, and I appreciate it, still kind of this maverick spirit in the space where we shouldn't be forced into the normative processes of traditional finance because, gosh darn it, this is crypto. But when it comes to being accountable for somebody else's money, I have to be thorough, right? And I have to be diligent, and the analysis has to be there. So there has to be kind of this proper intersect between VCs and what we do, and I don't know, the independent nature of having a startup in the crypto space. Now, let me say this before I pass it back over to Dave here. Some VCs perhaps don't get back to you in time, or are not kind in meetings, or do exhibit behaviors that maybe don't engender them to the community. But I don't think that's fairly representative of everyone at a VC by any means.
Yeah, I would say one thing to note is from a VC standpoint, from the due diligence process, when looking at Cardano specifically, it's a unique language, it's a unique chain. So understanding the development resources needed really to get on chain and to code has been limited but is still growing strong. That is one thing I have noted in just in general and the research that I do, kind of following where the trends are going, and where projects are moving, where development resources are moving. There's growth on the Cardano side, which is great. You know, obviously you're going to have your first movers with Solidity and Ethereum, and Cardano is different significantly. However, that doesn't mean it's bad by any means. So that I wouldn't say there's an inherent VC negative outlook or PE negative outlook to Cardano. It's just really just comes down to resources.
I guess I hear many horror stories from other companies trying to raise capital, and you know, they will step into a meeting room with a VC, and as soon as they hear the word Cardano, they recoil in disgust and go, "Oh my God! Well, why are you even considering building on Cardano? It's slow, it's antiquated, it's a scam even." So you hear a lot of stories like that, and then they have to sit down and sit through the whole education process, teaching them, you know, this is why we're building on Cardano, etc., etc. So it's good to know that you guys are definitely open to it. You understand the technology, and you've gone through that process of understanding the projects that are building on it, and not just recoiling from the word itself and the bad reputation, I guess, or bad media that's been going out in general around the chain. So it's good to hear.
Well,
Now,
if someone comes into the room and is rebuffed because of Cardano, they've not clearly or effectively presented their idea, their product, their service, because that's a secondary conversation, right? What's you know, tell me about your tech, tell me about your environment, because to know that, to get to that point where I'm really interested, I need to know if this is a viable project, you know. So for your friends who come back with that feedback, let them know that maybe that they could sequence the presentation a little more optimally. They could work on their messaging, and then that conversation would be much easier to approach with the folks in that scary room, because they want what you have. We just got to iron out a detail, and you have the explanation in your back pocket.
Gotcha. That's really good advice. So don't start your pitch deck with "we're building on Cardano," essentially.
Yeah.
Okay, so we've got some other questions from the community here as well, and this one's in regards to like how do you guys still hold on to your investments? Yeah, I know my portfolio might be down like 99% at the moment, and you know, some VCs that gotten in the bull market would be down quite considerably as well. So how do you guys hold on? And you know, I guess your limited partners and LPs are like squirmish as well. How do you guys hold on through the bear markets?
John and I have handled this quite a few times. It all comes down to risk mitigation. There's some investments, like if we get in pre-seed or early stage round where we have tokens that are locked up for 4 years, well, there's nothing we can do. We can just, you know, watch it ride the waves, enjoy what's happening. But from what's liquid, that's actively being managed, it really just comes down to risk mitigation. There are times where John and I have had some uncomfortable conversations with GPs and even LPs where we're saying, "Hey guys, it looks all rosy right now, but the direction is shifting, and here's our expectation. And yeah, it's 6 months out, and 6 months we're looking at an 80% retrace. Yes, we're basing this off of what's happened in the past, and yes, it sounds crazy, but you're also talking to the guys that have been around the block and have done this a couple times and have been through some cycles and handle this on a day-to-day basis. You know, this is our job. This is what we do, and we're not part-time or anything like that. So it really comes down to risk mitigation. You take your profits off the table. You know, you never lose money holding cash. That's for sure. And this isn't financial advice by any means whatsoever, but you know, $1 in your pocket, still $1 in your pocket. So I think it really just comes down to risk mitigation. Take your profits, you cut your losses, cut them early. You cut them before you're down 30, 40, 50, 60, 70%. And as soon as you think that the market can't go lower, it takes another leg down, and we're down lower. And inversely, if you're down 99%, it's actually going to take 1,000% to recoup where you originally were just to break even. So the VC firms, the trade prop desks, your actively traded, actively managed portfolios underneath those umbrellas, they rely on risk mitigation to ensure that these big drawdowns don't hit the LPs or the GPs, and you don't have to have those uncomfortable quarterly or monthly meetings and have to explain why you're still holding or what's going on with the portfolio.
Yeah, I've spoken to some other projects that are that were building at the beginning of the bear market, and I think unfortunately for them, their VC LP tokens were being unlocked at that top of the market, and as the market was going down, every month they would sell their tokens. And I guess that's part of your risk mitigation, like what you explained there. It's the best option right now is for us to sell because the market's going down. It's the beginning of the bear market. This could go down forever. So it's definitely, I guess, the reason why VCs would be selling their tokens at those particular points in time.
Well, and you should also note, though, that just because you sell at the top doesn't mean you're not buying on the dips and selling on the tops and really trying to accumulate, a larger amount of quantity of tokens and take that position and really amass. If you believe in the project, you believe in the team, you want to amass a lot of those tokens if the tokens have that real use case. So there have been times where we've had tokens unlocked, or there have been situations where tokens have been unlocked and we've sold them, and then we've bought them back a week later, 3 days later, 5 days later, and then we sell them a couple times, in the next week or two, and then we buy them back. And this process has gone over, months and months and months, where we've taken that same initial capital, but we end up with, a reduction of cost by 30, 40% across the board of the token. And we're holding 30, 40% more. So just because they sell, and that's going to happen, there's overhead, there's costs and whatnot, but it doesn't mean they're not buying back as well. And a good firm, a good partner that is investing in you, you'll note when a bear market comes, if they're building up a larger allocation, and you can check wallets and all that, but if they're building a larger allocation, you've got a good partner that believes in the company.
All right, really good to hear. Now, this is another broader question for you guys, and it's why are you guys even looking at Cardano? Like, what got you interested in Cardano-related projects? Is it purely the tech, what problems people are solving, or is it Cardano, the blockchain in general?
John, you want to go ahead?
Yeah, I think it still has endurance. That was one of my initial opinions, is that it would be one of the more enduring names, and it's I think achieved it at this point, which is attractive. So there's some stability. There's a lot of possibility with what can be done in Cardano, and that's very cool to me. And then just holler back, shout out to Genius X here. They put together a good crew and a good incubation for that space, and that's where they started collecting the eggs was in Cardano. So it made sense.
Okay, brilliant. Now we've got about 15 minutes left on this live stream. So if anyone has actually got questions from the live audience, please feel free to ask them in the chat there, and I'll feed them through to the team. But we also have some other community questions here, and these ones came off Twitter. So next time we do these live streams, make sure you keep an eye out on the Twitter account, and you'll be able to put in your questions as well. But this one comes from Sunny Basra from Soundrig, and they're building a Web3 app called Tunes, and that brings brand new emerging music artists to various listeners. Now, they're wondering, you kind of mentioned this a little bit earlier, but they're wondering when is the best point in time to bring their pitch to a VC firm?
Yeah, so that's a great question. We get projects sometimes that we wonder why they're asking for this money. There's not no, really, just really there's no projected use of funds. Their timeline doesn't reflect anything that's going to require the funds that they're asking off their $50 million valuation. So we're left asking why, right? Where I think I'm a fan more of somebody pursuing revenue at least with equal effort to just this type of funding. If you could get out and get your business started first, and it's a decision between that and taking on funding, fundraising is going to distract you from your business. It just is. And if that's not a needed distraction right now, that's probably something to factor into your decision making. Fundraising is tough. You get kicked in the teeth a lot. It's not fun. Fundraising makes you question yourself and your projects and all sorts of things, and it can make you, very hard and very confident at the end of it. But if you don't need to do that, maybe don't enter into it. If you're not sure what you're doing, and we mentioned coming correct with your pitch and presentation. If you're not sure what you're doing yet, take some time to examine the process, to talk to some people. There's folks like David and I who will talk to you, and tell you where to look and where to start. So gather a plan before you start fundraising. See if it fits your business needs. Otherwise, there's always going to be the opportunity to ask for money, because there's always going to be greedy speculators who know they can make money off of your business. So don't feel like, oh man, it's now or never to do this thing. It's probably not.
You got anything to add there, John?
Yeah, I think, I mean, it's pretty spot on. I mean, raising money is an endeavor. You're in meetings back to back to back. You're doing your follow-ups if you're doing it correctly. And being on, I've raised money for companies. I've also, been on the VCPE side. So I see both ends of it. It's a grind on both sides. It's a process. It's going to be distracting. If you can make money now, make it, because that makes pitching and raising money so much easier. And we've run across that where some incredible companies have flat out told John and I, we are not focused on making money right now, but we're asking you to invest in money when creating revenues isn't an interest of ours currently. It baffles me when you have the ability to do it and you don't do it, but yet you're still going to ask for investment. So definitely come correct when it comes to raising money, and sure, exactly what you're doing with it. Have that plan, have
that may work for large projects, Dave, but we're not dealing with chat GPT sized bites in this space usually, right? We're dealing with folks who have the perception of, I have this big value and I can get these big funds, and then just develop peacefully right off the money we raised. Most projects, I don't think are large enough to make that a sustainable plan.
Yeah, it would be great though to have enough funding to burn with $3 or $4 million a day like ChatGPT is doing with a free service. I couldn't imagine.
That's a lot of money. That's a lot of. I thought it was a lot more than that even, but yeah, it's definitely a lot of money to burn on a free service. So I'm sure they're working out how to make revenue off that. Now I'd love to. Yeah, go on.
I was going to ask that project that's doing that's entering the music space. That should be one of those things to note. And John and I noticed this. Oh, I don't know what 6, 8. Maybe almost a year ago, but the being in the space and following trends and seeing things, companies that are trying to address music rights, distribution rights, and ensuring that payment process of not 80% of the money is getting lost in the middle from revenue generation to the end artist, but really trying to bridge those gaps. Same things with movies, same things with comic books, your digital media. That's something that be interesting to note, and I'd love to see some of those projects come to Genius X. I'm not trying to plug anything, or maybe I am, but I see that emergence in that technology and really trying to bridge those gaps where the artists are getting more of the money, the users are spending less money. It's not going to cost me $3,000 to go see Taylor Swift or wherever the next big concert is. I'm buying it directly from the artist, and it's $100 or whatever. But those types of projects are really starting to bridge the gap of real problems and providing real solutions that save your end users money, save time, give them something that they want. I want to go see this concert. I want to be able to hear this artist or have some more direct contact with these artists even. So those types of projects I'd really, for what it's worth, I'd really welcome to see come to Genius X and
I happen to know a few of them. I'll pass them along, and they're all building on Cardano as well. So it's there's probably 3 notable ones in the music space building on Cardano. So it's interesting that you mentioned that. So I can pass along names for you guys if they're interested or if they're at that stage yet. Now, for those projects that are potentially jumping in and getting VC funding from you guys, like what should they be looking out for in a VC firm? Are there some red flags they should be looking out for? It's like, this isn't the firm for me. I'd love to understand that from that point of view.
VC's,
Go for it,
VC's
Nick.
early stage. Yeah, I was just going to say pre-seed or angel even, or pre-seed or even the seed round. They need to provide value to you, except aside from just writing a check. I was just going to say that if they're just writing a check and that's it, that's all they're doing for you. Hey, it's hard to turn down money, but your expectations should be higher. So a red flag, first and foremost, would be a firm that's willing to invest just a chunk of change, but nothing else. No manpower, no networking, no development or other resources, branding. I mean, John, when it comes to creating a pitch deck and creating the verbiage needed to be direct and punctual, I mean, it's one of the things he excels at exceptionally, and one of the massive values he brings to some of these projects early on that really is a tangible resource, and they can see it as far as the conversations that they're having. So if they're not providing an additional value, I'd consider that a red flag.
Everybody's project is the greatest thing since sliced bread, right? I mean, everybody's project is right. It has to be. So when I want to say, work with those who treat you well, but I have to temper that a little bit in this space, because if somebody doesn't like your project, you're probably not going to feel like they treat you. So when you're talking to someone on the front end and they're trying to find out more, look for somebody who wants to hack this thing to death so that they can find things that actually work. Because if you brought them something that can survive the onslaught, you've got somebody who values what you have, right? Sometimes we see this again, I think in overcapitalized niches, but sometimes certain projects are somewhat commoditized. Oh, you are a PDE game. Oh, you are a metaverse. You are, a music smart contracts. And while in a macro sense, that's pretty true, if you've not distinguished yourself at all, and they don't care and they'll still accept you, they're not really interested in you or your product, right? Try not to find yourself in, or your service. Try not to find yourself in a situation where you have to say yes to capital. I know it's weird, right? Because we fundraise and we go and we need it. We have to say yes. It has to be there. There's no runway without any dollar signs. But when you're desperate, it can be smelled. We see things that happen where we hear these stories from founders that we've met with, where there are tactics, sure, where a VC could smell desperation and push you off towards the end of the round, coming back demanding better terms. Okay, we've seen recently some of our friends in the space who have brought us term sheets that we've said not just no, but heck no, right? So there are lots of landmines in term sheets and in agreements. Not that every type of arrangement is bad, but understand that in the way that some of these, especially equity deals, can be structured, there's not there's not a lot of standardization. There's not something that may be so weird that it's impermissible. They can slide through lots of things in term sheets. So, you know, watch for dilution, right? Watch for hinging on certain milestones that may not be achievable with a penalty that comes in. Hey, raise this X amount of funds by this date, or else we get this much equity. Now that may be a deal maker, okay? That may be an excellent deal for you if you're getting what you need. And like Dave said, you have a value investor who's really giving you value and otherwise couldn't come on, right? Great. But if it's not what you're looking for, and if it's gonna suck you out of places where the pond doesn't have any water in its puddles, don't do it. You don't enter into agreements that are going to trap you or that you can't honor, right? Those are kind of things to watch out for. I don't think that there's tons of unscrupulous VCs. Really, the bigger risk is getting your project taken over, getting into a bad deal. You know, sometimes in niches where we see lots of activity in a short period, maybe there's too much acquisition and some projects kind of get stifled a little bit, right? But in general, no, just make sure you're getting the deal that you need to get, and deal with somebody who respectfully will push back on your project, wants to find the flaws, but then wants to treat you well because you have something that's valuable to them.
That's some absolutely brilliant advice. And what about how much should projects be asking in terms of funding based on how much they're potentially going to generate in terms of revenue? And I guess that's even hard to try and work out because, you know, if they're pre-fund, then how do they even know how much potential revenue they're going to generate, etc.? So it's a lot of things to work out, but how much should they be asking for based on how much they're potentially going to earn?
Well, there's a genesis of a bigger problem here that results from a poor valuation process, right? It originated in the process of drafting my valuation. I'm going to think, I'm worth this much. I can extract this much. I can do this much more with this much more funding, right? But you have to realize that the amount that you can extract is proportionate to your overall value, to the valuation of the business. I can't say I'm going to raise 20 million on a value of 10 million. That's nonsense. Do you see what I'm saying? So when I'm valuing my business, I need to be reasonable. I also need to think about future rounds. All right.
Yeah.
So I don't want to walk back. I don't want to walk back around. Investors don't like, you know, down rounds, and they're not fond of flat rounds that much either. You know, they like to see progressively stronger rounds of investment, progressively more prominent lead investors and participation increasing, right? This shows momentum. This shows trajectory and growth. But if I say that I'm going to need more money than what I actually need, I'm going to have to inflate that valuation to try to get it. And I'm setting myself up to be disadvantaged in future rounds. We mentioned a few minutes ago, right? Don't ask for money you don't need. I mean, reserves are important, and, you know, yes, definitely plan well, but don't ask for money that you don't need. And I think that that relates to this question as well.
Okay, you mentioned a little bit earlier if you enjoyed getting kicked in the teeth, this kind of lifestyle is really good for you. This sounds brutal. If you're going through, you know, you're going through your first initial fundraising with a VC, and then you have to go through subsequent raises afterwards as well, and you have to go through sleepless nights through all this as well. This for me, this isn't the life for me. So it's definitely something that I wouldn't do running my own business, asking for VC capital. But I know a lot of other people are wanting this just to take their businesses to the next level. So it's really, really interesting to hear all these views and perspectives from you guys. So thank you so much for sharing everything. Now, I do know we're coming to the end of our allocated time period. So I just wanted to check if you guys are okay with just going a little bit over just to get through a couple more questions from the community.
Sounds good,
Yeah,
Pete.
definitely.
All right, brilliant. So maybe one of the pressing questions is around regulations. And, you know, in the United States, regulations are, I guess, a little bit all over the place at the moment. It's a very dynamic changing landscape. Here in Australia, we're going through a token mapping exercise at the moment with a consultation paper, and people are responding to that at the moment. And it looks like it's going to be a really good space here in Australia for crypto projects in general. But how does regulations affect VCs in general? How is it affecting them at the moment? And what's the future outlook? Do you put that into your scope and perspectives of jumping into projects as well?
Absolutely. You have to. If you're going to, I mean, my job is to advise on investments, and I advise on something that is not going to pass any kind of compliance smell test here in the near future. That's bad advice. I know it sounds like I'm trying to simplify it, but I'm paid to give good advice. And if something looks like a sinking ship or something has lots of problems in it, then I can't suggest that direction at all. The FTX example, I know we're over time here, but I think is like the perfect example of VCs who did not perhaps have that compliance forward mindset that I think we're going to see lots of them adopting here. Dave?
I mean, there's some aspects where companies are withholding information that are important that they're not going to show, and then that goes back on the company. But FTX, for an example, everyone was drinking the Kool-Aid, and usually you don't see these issues in later rounds. I believe it's Series A or Series B, whatever. The early stages are the hardest in the world. They're the most difficult. But anybody that is going to be investing should be worried about whatever legal landscape that you're sitting in, if you're here in the US, in Australia, in the UK, or wherever, as it's ever changing. And though the rules are being defined, where compliance plays into effect on where your retail users or where your institutional users or who's buying your product. So it's essentially to start with where your company's domiciled and that legal landscape, and then from there, where are your clients domiciled?
Right.
Who are you doing business with? How are you doing business? Are you a DeFi protocol that's giving yields? Well, do you need a money transmitter license? Do you have, all these other compliance areas that you might need to address? So it needs to be taken seriously, because inevitably what could happen is everything goes away, meaning the company, tokens, the product itself, and you're left with, well, a sinking ship, like we saw with how many other companies this past 12 months that seemed on the up and up. FTX, Celsius, Voyager. I mean, I don't think we have enough time to go through the entire list.
That's okay.
I have a question too, which for David and John. If do you favor or disfavor certain companies depending on where they choose to have their or be incorporated at? Because now crypto companies are kind of saying, hey, we can incorporate anywhere in the world based on if it's a crypto friendly place. So would you say, hey, if you guys are incorporating in US, is that a potential negative for you? Or if they choose to incorporate in a different country that's more crypto friendly, could that be potential positive for you?
No, if they're gonna launch in a United States market and have a good plan, the wherewithal to do it, that's great. But there's certain jurisdictions that were known for I don't know, Dave, how can I put this diplomatically, for being excessively permissive with certain crypto businesses, right? I think that those jurisdictions are probably all out now. And so when someone says, I'm opening a business here, and we know that they could open it elsewhere, it's definitely worth asking a question, because those loopholes are not going to be as easy to travel through in the near future. And so does that mean that you're going to have to pick up and move? Does that mean you're not going to be able to do what you think you can do, right? Because, I don't know, Arthur Hayes already did it and the jig is up, you know? Those are conversations that we're hearing more now that we didn't before. So yeah, where you started up can make us take pause, or at least ask some questions. We're also going to look, though, Kimba, where are you targeting your customers? Dave mentioned this. If you're targeting your customers in a more permissive regulatory environment, in emerging environments, you know, that's an easier conversation to have. But if you're expecting to, do, I don't know, complicated wagering in gaming or DeFi yields that are going to draw some attention and probably make your life harder, that muddies your path to revenue. So it is significant to us.
And increases your cost of revenue, because the ongoing legal fees are going to be, you know, intense, to say.
Getting a legal opinion written is not cheap. And it's just an opinion. So something to consider.
It might not stack up in court, so that's great. Okay.
Oh, and if things go bad, is a company in the US going to invest in a company that's in, you know, insert a different company here, and something goes bad, and now we have to get legal involved, and now we have to go to get legal fees or spend legal fees in a different country to fight a case that's overseas that could last for 2, 3, 4 years. So they're all, I wouldn't say it's a red flag, but I would also say from the VC private equity side, it would definitely need further conversation.
All right, brilliant, guys. I'm going to slowly wrap this one up, but this one here, this comment came up from the live stream, and I just wanted to dig into this one and understand what was going on here. David Hooverman, the Wax King. What is that? I'm sorry, David.
Well, I'm a man of my word, and I've at a point in time, I made a bet, and I lost this bet. And this was a bet of Bitcoin. The price was ranging in a bear market, and I said, this is, you know, some time ago, I said Bitcoin's going to hit 3,500 before it hits 5,500 on the trajectory, and it didn't hit 5,500 hit first. So I lost a bet, and that bet was, I won't say the group it was in or whatever, but it was a fairly large crypto group that has over 100,000 members. And I got a Brazilian wax on a live stream. Now, it was just my face, obviously, but I was waxed. I was given a Brazilian wax live stream in front of the entire community because I lost a bet. And that happened many, many years ago. So there are, well, it's made its way here. Now you know.
Okay, all right. Okay. I guess it hasn't left you. All right. So in terms of this conversation, it's been absolutely brilliant. We've learnt quite a lot from multiple different perspectives, from your perspective as VC investors, what you guys look for in various projects, and also from the project point of view for anyone that is looking for VC funding, how to make them stand out from the crowd and what they need to do to make sure they're ready to go forth and go down this what seems like a terrible path, really, to go for VC funding. If you're got the right project and you're kicking goals, yeah, sure, it's fine. But it doesn't sound like the life for anyone, a regular Joe like myself. But thank you so much, guys, for joining me on the podcast and being part of the first Crypto Talk series. Is there any last words that you guys like to leave for the audience before we sign off?
Well, I want to apologize for the Dave's wax story. That was uncomfortable. It's really not. It really is maybe not as hard as we're making it out to be. And there are folks who will fundraise for you if you're not into doing it. But if you commit yourself to the process and you do it at the right time in the right way, it's not a nightmare. You can meet great people, you can make lasting connections, and you can really get your project ahead. So I don't want to leave with the impression that it's so brutal it should be avoided. No, it's necessary for innovation in our space, and done correctly, it can be enjoyable. You just got to have some thick skin.
Yep. And yeah, it gets easier along the way. But definitely just want to say thanks for having us. Thanks for having me. This was a blast. And I think what you're doing for the community overall is great. You know, education and conversations like these are informative, and they help everybody else out in the space and help the space grow completely, you know, in the right way. You know, for those that have projects like this that are budding or whatnot, you know, talk to Genius X. You know, you have a crazy team of advisors that are able to come in and help and guide you along this process and provide that value that can help you get the funding, that can help you get the exposure across the board. So, but thank you. I hope to do it again someday, and definitely. I'm watching videos as well, right along with you, with other guests that hopefully I hope that to see on this show and sit in this chair.
Yeah, I like to add, you know, definitely thanks Dave and John for joining. Thanks Pete for, you know, helping us organize this. And yeah, on behalf of everybody out there, it is a hard journey, but you know, keep building, focus on adding value, and definitely there are strong resources out there in the community. You can reach out to us if you're interested in our program, and we're definitely here to bring the most value that projects can bring. So definitely free to reach out and stay confident and keep at it.
Brilliant, guys. Now, I know the Genius X team will be slicing and dicing this video up to post up on their YouTube channels. So if anyone's interested, they can check out the shorts and clips on the Genius X YouTube channel. I'll put the links down below for everyone so they can get to that as well. And of course, you can find out more information about Genius X by following their Twitter account, official Genius X, or looking at their website, genius-x.co. You can also look into BlocTech investments as well. I'll put the links down below in the show notes. And of course, if you're loving this type of content, please make sure you give us that thumbs up, hit that subscribe button, click the notification bell, or leave us a rating or review anywhere you're listening to your favorite podcast. It's muchly appreciated. But thank you, gentlemen, again for joining me on this podcast episode. It's been an absolute pleasure learning more about how VCs operate in this crypto space. It's been very enlightening.
Thank you, Pete.
Thanks again.
Thanks. Thanks, Pete.
And thank you for everyone on the live stream as well. It's been a pleasure having you guys here. We've got to do more of these lives. All right. Thanks, guys.